All right, strap yourselves in. We're diving deep into the gold market this week, October 28th to November 1st. We'll be looking at global events, the U.S. economy. Oh, and we can't forget how central banks are playing the gold game these days.
What's fascinating, while everyone's focused on the short-term price swings, there are these long-term trends in gold that often fly under the radar. We'll be sure to point those out.
Okay, so let's start with what's happening globally. We've got some serious geopolitical tensions out there, and gold, well, it tends to heat up when the world feels uncertain, right?
Exactly. You can think of gold as a kind of insurance policy against global instability. And right now, that situation in the Middle East, particularly between Israel and Hamas, it's definitely adding to that unease.
Yeah.
Any escalation there, and investors will be scrambling for safe havens. And gold, that's often at the top of the list.
So more tension basically equals more demand for gold, which could push prices higher, right?
Precisely. And then there's the U.S.-China relationship. Another wild card in the deck, always a source of uncertainty. Trade disputes, tech rivalry, you name it. Any of those things could flare up and send shockwaves through the global economy.
And a shaky global economy makes investors nervous, which, again, could benefit gold.
You got it. But here's something interesting. There's another trend that's been quietly supporting gold. Central bank buying. A lot of countries, especially in emerging markets, they're looking to diversify their reserves, move away from the U.S. dollar.
So they're swapping dollars for gold. What's the reason behind that?
Well, gold is seen as a safe and stable store of value, especially during times of economic or political turmoil. It's a hedge, against a weakening dollar or a shaky financial system. And we're seeing central banks, like Russia, for example, they're actively shifting their reserves into gold. And I mean really actively. They're not just talking, they're taking action.
That's really interesting. So we've got this global backdrop of uncertainty, but then we zoom in on the U.S., and there's a whole other set of factors at play there too, right?
Absolutely. This week is packed with U.S. economic data releases. And the big one, the FOMC meeting, starts on October 31st.
The Fed, right, the Federal Reserve, they set interest rates, and that has a big impact on gold, doesn't it?
Huge. See, gold doesn't pay interest like a bond or a savings account does. So when interest rates are rising, holding gold becomes less attractive. You're missing out on potential returns elsewhere.
So what data should we be paying attention to this week?
3 big reports to keep an eye on. First, U.S. GDP growth for the third quarter. That comes out October 30th. A strong number. Well, that gives the Fed more reason to keep raising rates, which would probably be negative for gold. But if the GDP report is weaker than expected, the Fed might hesitate. And that could be good news for gold.
So a strong economy, bad for gold. Weak economy, potentially good for gold.
Yeah, it's simplified, but that's the general idea. Then on October 31st, we get the Consumer Confidence Index. That basically tells us how optimistic people are about the economy. Higher confidence usually means less interest in safe havens like gold. If confidence takes a hit, though, that could boost gold.
So it's all about how people are feeling, really. Are they feeling confident, or are they feeling a bit more cautious? And then, of course, there's the big one, the jobs report, right?
You got it, non-farm payrolls.
Yeah.
NFP comes out November 1st, same day the Fed meeting wraps up. That report tells us how many jobs were added or lost, a strong number. That means a healthy job market, which could make the Fed raise rates again. More pressure on gold. But if the jobs report is weak, it might signal that the Fed's rate hikes are starting to slow the economy down, which could lead to a dovish stance from the Fed.
Hold on, what does dovish mean in this context?
Dovish basically means the Fed is concerned about economic growth, might be less aggressive with those rate hikes, or even consider lowering them in the future. That would be big for gold, definitely a positive.
Got it. Strong economy, hawkish Fed, bad for gold. Weak economy, dovish Fed, good for gold. But even with all this data coming out, it still feels like we're guessing, doesn't it?
Absolutely. Because what the Fed actually does is a mystery until they make their announcement. And their words, their tone, it can have just as much impact as their actions.
So even if they don't raise rates this time, but they sound like they're going to keep raising them aggressively in the future, that could still hurt gold.
Exactly. But if they sound more cautious, more worried about the economy, that could send gold prices higher, even without a rate cut right now. It's all about reading between the lines, trying to anticipate their next move.
Okay, so we've got global tensions, we've got central bank buying, a whole bunch of U.S. economic data coming out, and a Fed meeting that could go either way. It sounds like the gold market is in for a wild ride this week.
It really does. And there's one more layer to consider, how gold interacts with other financial markets.
Oh, right, because gold doesn't exist in isolation.
Not at all. The U.S. dollar and Treasury yields, They both tug on the gold market. Sometimes they pull in the same direction, sometimes in opposite directions. Understanding that interplay is really key to navigating the gold market this week.
I think we need to unpack that in part 2 of our deep dive. We'll explore how the dollar and Treasury yields impact gold prices. And we'll dive into some tools for reading the market's mood and trying to anticipate its next move. Stay tuned. Welcome back to our deep dive into the gold market. Part 1, we covered the big picture stuff. Global tensions, central bank buying, all that economic data coming out of the US this week. It's a lot, I know.
Yeah, it's a lot to take in, for sure. But I think connecting those pieces helps us understand what could move gold prices in the near term. And now we're going to zoom in, look at how gold interacts with other financial markets, specifically the US dollar and Treasury yields.
Okay, let's start with the dollar. Everyone always talks about it being strong or weak, but how does that actually impact gold?
Well, gold is priced in US dollars, right? So when the dollar gets stronger, it basically makes gold more expensive for buyers using other currencies. Imagine you're in Europe and the euro weakens against the dollar. Suddenly you need more euros to buy the same amount of gold. That usually dampens demand, pushes the price of gold down.
So stronger dollar, weaker gold, weaker dollar, stronger gold. It's an inverse relationship, right?
Exactly. And a lot of factors can influence the dollar's strength. Interest rate differentials, economic growth, even safe haven flows during a crisis. If the U.S. economy looks strong, for example, or if the Fed signals more aggressive rate hikes, well, that can attract investors to the dollar, put downward pressure on gold.
So it's really important to keep an eye on the dollar if you're a gold investor. What about Treasury yields? You mentioned those were important too.
Right. Treasury yields basically represent the return an investor can get from holding U.S. government bonds. And remember, gold doesn't pay any interest. So when Treasury yields go up, holding gold becomes less attractive. I mean, why hold an asset that's not generating any income when you could get a decent yield from a risk-free government bond?
So rising yields could make people sell gold and buy bonds instead, driving the price of gold down.
That's the basic idea. Of course, it's not always that simple. Sometimes you see gold and Treasury yields rising together, especially if inflation fears are driving both markets. But in general, if yields are climbing fast, it's usually a headwind for gold.
Okay, so the dollar and Treasury yields, they're both pulling on gold prices. On top of all those economic data releases we discussed. But it's not just about the numbers, is it? There's also that whole market psychology piece we have to think about.
Exactly. And there are a few tools we can use to get a handle on that. One of them is the Commitment of Traders Report, or COT report for short. It's released every Friday by the CFTC. It tells us how different groups of traders are positioned in the gold futures market.
Futures market, those are contracts to buy or sell gold at a specific price in the future, right?
That's right. Now, the COT report breaks those positions down into 3 main categories: large speculators, often hedge funds, small speculators, and commercial traders, who are usually businesses that use gold in their operations.
So by looking at how these different groups are positioned, we can get a sense of whether the market is feeling bullish or bearish on gold.
Right. For example, if we see a large buildup of net long positions among hedge funds, well, that could be a signal the market's getting overheated, and a price correction might be coming. Net long means they have more buy contracts than sell contracts, essentially betting that the price is going to go up.
And net short positions?
Those mean they have more sell contracts than buy contracts, betting on the price going down. So if we see a lot of those net short positions, it could signal that sentiment is too bearish. Maybe there's room for a price rally.
So the COT report, it gives us a little peek into the minds of traders. What are some other ways we can gauge that market sentiment?
We can also look at gold ETF flows. That tells us how much money is flowing into or out of gold-backed exchange-traded funds. And then there's sentiment analysis. Uses algorithms to track news headlines and social media posts to figure out the overall market sentiment.
So it's like piecing together a puzzle, right? We're looking at economic data, Fed policy, market positioning, sentiment indicators, all to get a better sense of where gold might be headed.
Exactly. Yeah. But we can't forget about technical analysis either. This involves looking for patterns in historical price charts to identify potential support and resistance levels.
Technical analysis, that's the part I've always found a bit intimidating.
Well, think of a price chart as a sort of battlefield between buyers and sellers. Technical analysts look for areas where buyers have historically stepped in. To support the price, those are called support levels. And they look for areas where sellers have stepped in to cap the price. Those are called resistance levels.
So if gold approaches a support level, that might be a good time to buy because we expect buyers to come in and push the price back up.
That's the thinking. But of course, these levels aren't foolproof. They can be broken, but they can give you a framework for understanding potential price action.
Okay, so technical analysis is basically using historical data to find those turning points. What are some of the key levels we should be watching for gold this week?
Well, technically speaking, gold has a key support level around $1,920 per ounce. If it breaks below that, we could see more declines. On the upside, there's resistance around $2,000. A break above that could signal a strong move upward.
So $1,920 is kind of like the floor, and $2,000 is the ceiling.
That's a good way to think about it. Keep in mind, these levels are based on recent price action. They don't account for any new information that might come out this week, but they give us a starting point, help us understand the potential range of movement.
So we've got these technical levels to watch, plus all the fundamental factors we talked about in part one and the COT report, other sentiment indicators. It's like this multi-layered map of the gold market.
It is, and navigating that map takes understanding these different elements.
Yeah.
And being ready to adapt to changing conditions because the gold market, like all markets, is constantly evolving.
This has been so helpful, but with all these different factors at play, where do you see gold headed this week? Give us your expert prediction.
If I only had a crystal ball, right? Honestly, it's too close to call. Strong arguments can be made on both sides. If the economic data is strong and the Fed keeps sounding hawkish, gold could struggle. But any weakness in the economy, any sign of the Fed getting more dovish, or if those geopolitical tensions escalate, gold could really take off.
So it really could go either way.
That's what makes it so interesting. Gold is a fascinating market, always full of surprises, and that's what keeps us coming back.
Couldn't have said it better myself. Before we go to part three, where we'll discuss what all this means for you and your investments, let's pause for a moment, let our listeners process everything we've covered so far. All right, welcome back to our gold market deep dive. I feel like we've really covered a lot: the global landscape, the U.S. economy, even how to read the market's mind using those sentiment indicators and technical analysis.
And it might feel overwhelming with all those moving parts. But remember, the goal was to give you the knowledge to understand this market. It's complex, but it's incredibly fascinating.
For sure. But now comes the exciting part: putting all this knowledge into action. So what does all of this mean for investors, and how can we use it to make smart decisions about gold?
Well, the first thing, and this is important, this is not the week to sit back and watch. You have to be engaged, watch the data, listen to what the Fed is saying, and stay on top of any major news, anything that could move the market. Things can change quickly, so be ready to adapt.
So no snoozing allowed this week. Got it. But let's get more specific. What are some strategies investors can use based on everything we've talked about?
Let's start with those who are bullish on gold. If you believe that central bank buying, geopolitical risks, and a potential shift away from the dollar, if you think those things will continue to push gold prices higher in the long term, well, this week's volatility could create some buying opportunities.
Okay, so if gold dips because of a strong GDP report, or if the Fed sounds hawkish, that could be a chance to buy more gold at a lower price.
Exactly. Buy the dip, as they say. But remember, any investment decision should match your own risk tolerance and goals.
Right. Always good to keep in mind. But what about investors who are feeling more cautious about gold? Maybe worried about those rate hikes or a stronger dollar.
If that's you, this might be a good week to focus on managing your risk. Maybe tighten up those stop-loss orders on your existing positions. That can help protect against potential losses. Or consider hedging, maybe with a short-term bearish trade, if the data and the Fed lean in that direction.
So for the cautious investors, it's about protection and maybe even profiting from a short-term dip. But let's step back for a moment. Talk about gold's role in a portfolio. It's not just about making quick money, is it?
Not at all. One of gold's most important roles is as a diversifier in your portfolio. It historically has a low correlation with stocks and bonds, which means it often moves in the opposite direction. That makes it a valuable hedge against economic uncertainty and any turmoil in the financial markets.
So even if you're not actively trading gold, just having some gold in your portfolio can act like an insurance policy to help weather those unexpected market storms.
That's a great way to put it. And we can't forget about the psychological side of gold either. For centuries, it's been seen as a safe haven, a store of value when things get rough. That feeling of security, it can be powerful, especially when the world feels unstable.
It's like having a little peace of mind tucked away in your portfolio. I like that. But before we wrap things up completely, I want to leave our listeners with something to think about. We've talked about gold as a safe haven, right? But what does safe really mean these days? What are we protecting ourselves from? Is it inflation, geopolitical chaos, or a financial system collapse?
That's a great question. The definition of safe changes over time, just like the world around us. And figuring out your own personal definition of safety, your own risk tolerance, that's essential when you're making investment decisions, especially with something as unique as gold.
Absolutely. As we've seen this week, the things that drive the gold market are complex. It's economics, it's geopolitics, it's market psychology, even our own ideas about risk and safety.
Right, it all plays a role.
So we've given you the knowledge, the insights, and hopefully some useful tools. Now it's your turn. Take all of this information and use it to make your own decisions, ones that match your own investment goals. Keep learning, stay engaged, and don't be afraid to ask questions. That's how you become a successful investor. Thanks for joining us for this gold market deep dive. We'll see you next time.